Good afternoon, everyone. And today we welcome Mr. Rob Baur, who's the Chief Executive Director and Chief Global Economist for Principal Global Investors. And this promises to be a very, very interesting session of our Facebook Live. It's interesting for multiple reasons. One, obviously, Rob is a veteran in the industry. He's been there, done that, and he's seen the global economy all across. He's traveled to places, traveled to locations, studied countries, studied different zones basically, and we will definitely try and draw something out of his experience today. And secondly, the most interesting part is today's session is going to be all about the global economy and the Indian economy per se. So we'll try and draw some small pointers which can help our investors, which can help all of us to try and figure out how we analyze an economy, how we try and see the global health, basically. And that's what the crux of today's session is. So before much ado, I'll try and introduce Rob, though his introduction is fairly lengthy for me, but I'll try and run through his key profile. In his capacities, he establishes and directs global economy policy and strategy, oversees and conducts macroeconomic and quantitative research, forecasts economic trends and anticipates market movements, and advises the investment staff in making economically sound investment decisions. He's joined Principal in 1995, so that's 25 years of experience with Principal Group itself. And before that, he was Global Head of Trading for Principal Global Investors. So Bob received a Ph.D. in Economics and is a bachelor's degree in Mathematics from Iowa State University. And Bob, needless to say, he has numerous speaking engagements and has a profile which can really enrich our customers today, enrich our clients today. So before we launch, Rob, and it's a very interesting take on economics, which I often find people talking about. So there's a small joke, and I'll try to start with a joke. There were these three economists who ventured for hunting once, basically. And they saw a deer running by. So one of them fired, and he fired like 1 meter left. The other one fired, and he fired like 1 meter right. And the third one started shouting, saying, "Oh, we've got it, basically." Right? So
there are lots of economic jokes, yes.
Yeah, absolutely. So that's the normal take on economics when we talk about it. But what's your personal take, having been a student of economics for such a long while in your career? Do you think it really matters to small investors? Do you think it should be studied seriously for us to define an opinion on investing?
Well, it certainly matters to any kind of investor. I think economics is really the basis for investment, because if the economy is not doing well, your investments in the economy or in stocks or in bonds may or may not do well. So I think what's going on in the economy is essential to understand about for investments. But can an ordinary investor really study the broad economy? I think that might be kind of hard to do. There's so many factors that come into create the underlying economic environment. And I think it'd be very hard for small investors to understand that. So probably best is to have a good financial advisor or a good financial company to help them with those decisions.
Understood. So basically, I once again welcome you all to this Facebook Live session of Moneyfront. And what Rob is mentioning is that if you have an advisor who can analyze the broad macroeconomic trends and define it for you in a simplistic term as to how does it impact your investments, it definitely does impact your investments. I think that's more needed. But we will try and solve some complex problems today as we enter into this. And one of the burning questions today all across: are we really going through a global slowdown? What's your take on that?
Well, we certainly have. We've been in a global slowdown probably now for maybe 20 months or something like that. It began in China as China tried to slow the growth of debt. Debt's been growing very fast in China, and officials are worried about a financial crisis down the road, so they tried to slow the growth of debt. They also tried to reduce the pollution in their country by closing some inefficient companies. So when you close companies, when you slow the growth of debt, naturally growth in China, economic growth, slowed. And then growth in companies that sold into China slowed too. Emerging markets, which sold commodities to China, Europe, especially Germany, which sold a lot of manufactured goods to China, those countries slowed. So the slowdown kind of migrated around the world. Now the U.S. slowed. We had some specific conditions in the U.S. Hurt us. We had large inventories of aircraft and inventories of automobiles that kind of slowed growth. But I think we're just in a stabilization process now worldwide, and I think frankly we look for growth to pick up modestly anyway into 2020. I think there's a little better momentum in China. We're seeing just a little better month-over-month growth. I think growth in the U.S. momentum is picking up. In the Eurozone, they're lagging a little bit, but I think growth probably bottomed in the October-November period. Japan is lagging a little bit more. I think their growth will probably bottom in January. So we look for a little pickup in growth into at least the middle or maybe the end of next year.
Oh, interesting. So the takeout here is that perhaps we might have bottomed out in terms of slowdown.
Yes.
Chinese economy looks like it's picking up, and European and Japanese economy, you say, are likely to pick up next year.
Yes, that's my belief.
And what's your take on this US-China trade war situation? How will it pan out? Do you think it'll like really impact the global economy?
Well, it has. Certainly it has exacerbated the slowdown somewhat. I think the slowdown was a little worse because of the problems between the U.S. and China. But the trade conflicts are really a symptom of a much deeper kind of issue. 25 years ago when China was first entering the world economy, the thought was, gosh, let's trade with China, get them part of the world economy. They might become more free, more democratic. Clearly that hasn't happened. And I think China is really intent on kind of regional domination and would like their economy to be the dominant economy in the world. Now, that's part of where the conflicts are, but I think the trade issues themselves, they have slowed growth in China. They may have slowed growth in the U.S. A little bit, but at least there seems to be a truce right now.
Okay. So you think we are now at a situation where whatever worse could have happened is behind us?
Well, I think it's somewhat going to depend on the election next year. If President Trump is reelected, given who knows for sure how he's going to operate in his second term, if there is one. If he's not reelected and a Democrat comes in, it's hard to know what's going to happen there. So I think there's quite a bit of risk in the U.S. election next year, but I don't really think that's going to reduce tensions with China. The trade conflicts between the U.S. and China are kind of bipartisan. Both Democrats and Republicans in the U.S. Kind of agree that that there should be some. How should we put it? That there should. The problems with China are kind of long-term in nature, and they're not going to go away.
Understood. And so look, I just want to understand, in every adversity there is an opportunity, right? So is there a spark of opportunity for other emerging markets or some countries because of this US-China rift? China perhaps not being able to export as much as it was, and some other countries trying and taking those zones from China?
Oh yes, we're already seeing that already. Part of globalization in some sense is starting to fade a little bit kind of naturally because wages in China have risen fairly dramatically over the last 20 years. So China is not nearly as competitive as they were, a couple of decades ago. So we're seeing Vietnam already is now, a lot of the shoe manufacturing has gone from China to Vietnam. So that's really positive for Vietnam. And as these trade conflicts simmer some more, there are some global companies moving their supply chains out of China. In fact, in your newspaper here a couple of days ago, the Great Wall, which is a large auto manufacturer in China, announced they were going to build a plant here in India. So that's very positive for India. We're also seeing some Chinese companies or global companies move their supply chains out of China. Some are going to Mexico. That's a positive. We're also seeing some come to the United States. The Kier Group, a large textile manufacturer, has got a plant in the Carolinas. Foxconn, which is a Taiwanese company that used to build Apple products in China, they have 2 plants in the United States. Apple is going to start making some of their computers in Texas. So that's, as supply chains move out of China, if that continues, that's an opportunity for lots of other countries where wages are still lower than they are in China.
So predominantly that will mean most of the Southeast Asian countries or countries like perhaps Philippines and Venezuela and all these South American countries, maybe because the wages are really low out there. Or
well, that's certainly where the beneficiaries are right now. I mentioned Vietnam. Dongguan in China used to be the shoemaking capital of the entire world. I was there a couple of years ago, and I think there was only one shoemaking company left. The rest of them had already gone to Vietnam, where wages were less.
Interesting. That's quite interesting. Okay. So all those who have joined us late on this Facebook Live session, we are having a candid conversation with Rob, who is the Chief Global Economist for Principal Global Investors, and we are trying and discussing what's happening around the globe in terms of the economic outlook, basically. And Rob's take has been very candid so far. Just to try and move the conversation to something which will interest our investors a little more. As an investor, Rob, I might not be very educated in terms of deciphering the economic noises around me, right? So what are those few key indicators which are simplistic in nature, which you track and which an investor like me or even more retail investor can track sitting at his home and figure out, okay, this is how the economic cycle is looking like? Any few key indicators which you think?
Well, there certainly are some, but I wouldn't say they're simple, and they're not easy to get. Maybe the easiest one that comes out every week for the United States anyway, it's called the initial claims for jobless compensation, meaning if you lose your job or then you can file for unemployment compensation. So every week there are these jobless claims are talked about or are released every week, and if those start to rise, then you know that some companies are laying off people, and the more they rise, then the worse the economy must be. But a lot of the other data, we have our own kind of recession dashboard. We've got 19 indicators on it. They'd be things like, besides employment, there'd be wage growth, there'd be financial things, what happens with the yield curve, our short-term rates higher or lower than long-term rates, industrial production, things like that. But as much as anything, those are really lagging indicators. When a number comes out, that's not today, that's about what happened last month or 2 months ago. So it's really hard for an ordinary investor to kind of keep track of those things, which is why we suggest the best thing for an individual investor to do is have a good financial advisor or follow a good company that keeps track of these things.
So you mentioned a couple of things, and I'll touch base both the things. You mentioned that those are predominantly, most of the indicators are lagging indicators.
Yes.
Right? Any prominent lead indicators which you track or which one can keep a note of?
Well, there are, like in the United States, there are 3 indicators that we follow that do suggest there's a more severe slowdown out there somewhere. Probably not next year, but I'm thinking it could have implications for 2021. I mentioned the yield curve, which had been inverted, meaning short-term rates were higher than long-term rates. Now, while that curve has uninverted, it's gone the other way, still, historically, that has been an almost infallible indicator of recession, leading by 6 months to 2 years, something like that. There are 2 other things. Profit growth, economy-wide in the United States, has kind of flattened out. It's really been, profit growth has been zero essentially since about 2015. The third indicator is job growth. Now, job growth is slowing somewhat. Fewer jobs were created this year than there were last year. So those are 3 good leading indicators that say there is a recession out there. Now, the risk to me in the United States is because profit growth has been flat, has been that maybe wage growth will continue to accelerate and be a drag on profit margins. So then we'll see maybe falling profits toward the end of next year, which could give rise to a profitability-driven recession in 2021, a mild one.
Interesting. So those are three lead indicators, and I'm sure Rob will vouch. These will work across economies, Rob, if the data is good?
Yes, I would think so. The problem with at least smaller and emerging market economies is maybe the data is not that good, or you don't know what the real data is for a long time.
But I think for investors, keep a tab on the yield curve. If it's getting inverted, it's a sign of a slowing economy and perhaps a recession coming down 6 months up to 2 years kind of a time frame. Slowing profitability growth.
Yes.
And the third one you mentioned was the job growth kind of. These three are critical data points, and I think these are all globally proven across economies, provided the data is of good quality, basically.
Exactly right.
I'll touch upon one more point which you mentioned, which was the inverted yield curve. Now, what is happening across the globe is interest rates has been hovering to zero, and now in a new uncharted territory where interest rates are getting to negative zone, and some perhaps around 17 trillion of tech portfolio across the globe is now in a negative interest rate zone. What does this imply? How should one read into it, and where's the global economy headed?
Well, in some sense, it's kind of bizarre that you would give a government money and 10 years from now you get less of it back. It kind of reminds you a little bit of going into a casino. You know, if you go into a casino often enough, on average, you'll get about $95 back for every $100 that you wager. Now, if you if you put $100 into Swiss government bonds 10 years from now, you'll get $95.46 back. So it's a little bizarre. I think what it's doing, the impact is really more negative right now. I think, for example, Japan and the Eurozone went to negative interest rates in part to hold down the value of their currency. Because the U.S. was not negative, we have much higher rates than in Europe. That was a drag on their currency. So the lower their currency, that tends to be a positive for their economy. So I think that's in part why that has happened. Long term, interest rates can't be negative. There has to be some positive return.
But there are news pieces which I've read which says that even the rate transmission to investors or to retail let's say borrowers have started going negative. So there are countries where home loan rates have gone negative actually, which means you borrow and you get to earn something out of it.
Oh yes, that's right. I've got a picture of a nice young Danish couple. This was in the Wall Street Journal a couple of years ago, where they were at a picture taken of the husband and wife and two little kids in front of their $270,000 house in Denmark. Every 3 months, they got a check back from their bank for $38.
That's amazing.
For having a loan. I mean, that's just bizarre is what I call it, still is.
So that's quite interesting for all those who joined us late in this Facebook Live session. What we are discussing is there are countries in the globe today where you can borrow from a bank and technically you don't have to pay anything, right? So there is what Rob was mentioning was in Denmark perhaps there are banks which are lending you money to buy houses and you don't have to pay them back. In fact, you receive something.
Well, ultimately you have to pay back the principal, but you're not paying an interest cost.
Absolutely. So that's the interesting world which we are living in, and it's kind of bizarre, but that's the reality of times in which we are living in, and that's kind of flooding global markets with cheap money, easy money still.
Well, it is. That's right. If you look in the U.S., there's been a huge surge of BBB rated funds in the investment grade index. Now, something like 50 or 55% of the investment grade is BBB, which is much higher than normal, which suggests if we do get a slowdown, some of those will be downgraded into junk status. There's also been a big surge in lending in high yield funds and also emerging market corporates. There's a big surge because investors, they got to have some positive return, and if you can't get it through government bonds, then they just reach for yield, and to get that extra yield, they have to take on more risk.
Absolutely. But are you also seeing some flight of money into safer havens like gold and perhaps crypto because of these negative interest rates across the globe?
Well, I might argue with your premise about a crypto being a safe investment, considering what has happened to Bitcoin. It's down many thousands of dollars from its peak. However, we have seen gold move up, but I think maybe what's gone into gold is maybe less a safe haven than the idea that inflation out there might be just a little stronger than people think.
Understood. So Rob's take out here on these two assets is that gold perhaps is not going up as much as because of the negative interest and the cheap liquidity across the globe, but because of
a little bit higher inflation. And gold, is an excellent inflation hedge over a long period of time.
Absolutely. And I think we in single line he has given his take on crypto. Okay, so we'll try and move because we have some paucity of time. What we'll try and do is now try and see, cover some bit of India because that interests our clients a little bit more than what the global economy is perhaps doing, though both are kind of linked. And that's my first question to you. How coupled or decoupled is India with the globe today? And do you think the Indian downturn, which everyone is talking about, that the economy is slowing, is more of a global phenomena that we are viewing? Or do you think there are indicators in the economy perhaps which indicate that there is a real slowdown happening in Indian economy also?
Well, I think the slowdown in India is more part of India's economy itself rather than related to the rest of the world. Okay. I mean, India has a trade deficit in general, so you're not exporting, so your exports to the world have not been a huge impact on the Indian economy. I think the current administration has done three kind of major things to try to set up India for better growth long term. They changed the GST
yes.
And made it the same across states, which made transportation much more efficient.
Yes.
They tried to demonetize, so to bring a lot of the underground economy out into the open.
Right.
And then maybe the key thing was to force banks nationwide to recognize their non-performing loans. Now, I think all three of those have had a negative impact on growth in the short term, while they're probably really good for the long term. The GST change has made some uncertainties about how to trade across states within India. The demonetization means that more people are paying tax within India when you bring the underground economy out in the open, which in the short term is a negative. And probably the biggest negative has been the forcing banks to recognize their non-performing loans. And remember, there was a big non-bank financial company a while back that that went bust. And so I think that has given a negative impression of the whole non-bank financial company universe. And as a result, the companies, small and medium-sized businesses that went to those non-bank finance companies for lending are finding it hard to get credit. So I think that's part of the problem. Now, there are some opportunities here because inflation is much lower in India now than it has been historically. And part of that is due to much better productivity growth here in agriculture. Yields are higher, so productivity is is greater. So the agricultural prices have not risen as far because you have better yields. So that should give the Reserve Bank here in India a little more room to lower interest rates, even lower than they have. They've lowered quite a little bit, but with inflation under control, I think there's probably some more room, which would help.
Interesting. So for all those who joined us late, I think Rob's take on Indian economy is that perhaps the slowdown is our own in terms of making, and the three critical factors which have really resulted in this is demonetization, GST, and the IBC or the banks being forced to kind of recognize the NPAs on their book, basically, which are negative in the short run, but perhaps will help the economy
good in the long term. I think that's the idea.
Right. But there are certain measures which now the government is trying and taking. So there are few announcements, a slew of announcements which the government have made, and some of the important ones being they've tried and reduced the corporate tax rates in the country to make it really competitive compared to the other emerging economies. And so do you think that those kind of measures can really help, or you think monetary solutions are still required?
Oh, I think probably a little lower interest rates would certainly help, but you mentioned tax cuts. I mean, I think that was a wonderful idea. We did that in the United States. You know, we cut corporate tax rate from middle 30% that range down to 21%.
Right.
And what that did was take away almost entirely the incentive for a U.S. company to move its headquarters to Ireland, you know, where the tax rate's 15% or something. So becoming more competitive with world tax rates in India is a very important thing. I mean, even in China, what did China do? A communist country, one of the first things they did was cut both corporate and individual income taxes about a year ago. So I think it's very important.
Okay. So my next question, which is a direct corollary to what we are talking, is corporate taxes have been reduced. Monetary easing has been happening, and I think perhaps the central bank in the country also recognizes that there is still more room because of lower inflation and other things and slowing growth. There is perhaps more room. You think something needs to be done on the personal taxes also out here?
Well, I'm not that familiar with personal tax rates here. I expect it would help. I mean, part of the problem, as I mentioned, is when you bring the underground economy out in the open, you have people paying taxes that weren't paying taxes before, and that's negative for the country. But also, I think there is room because the real interest rates are still high here. I think there's room for the Reserve Bank to drop interest rates. But I think also debt markets seem to be frozen a little bit. I don't know what the Reserve Bank can do to kind of loosen things up and maybe put gain more confidence back in the financial system so banks would feel freer to lend.
Absolutely. I think what you've highlighted is the crux of the problem out here. It's not so much of liquidity problem, but it's also a problem of confidence that today the non-banking companies in the country, or perhaps the largest of the banks, are also refraining from lending as much as they should have done, basically. So any quick ones as to how can this credit growth again be revamped in the country, or Well,
I think the Reserve Bank just has to be careful and not let the debt markets freeze up. I mean, if we start to continue to see a deterioration in liquidity, or if some prices of debt instruments get really cheap, I mean, the bank at some point may have to step in and, I don't know about guarantee the markets, but may have to do something on the order of what the Fed, what the ECB has done to kind of buy up some of the loans and provide some confidence back in the banking system.
Interesting. Rob, we want to discuss a number of things with you, but perhaps maybe some other time when you visit India, and we'll take a larger slot with you. But we are running out of time, and before we wrap up for the larger interest of our audience, I'll just quickly shoot out a few questions to you, and you tell me what your take is.
Okay.
So if I were to ask you for a 1-year prognosis, which according to you is the global across the globe is the country where you'd like to really go ahead and invest?
Oh, I think probably it would not be the U.S. I think there's more opportunity, perhaps in general, in emerging markets.
Okay. And any particular take in the emerging markets, or the entire basket?
Well, I think India here is, your valuations are probably a little high. I'm not sure I would pick this, but there are some places where valuations are cheaper, which might be a better opportunity.
Like, if you might want to share?
Well, I don't know that, I think there may be some opportunities in Brazil. For example, Indonesia kind of runs in my mind. Those are just a couple
Any
of places.
particular favorite asset class for next year?
Oh, for next year, I think there's some modest upside for stock markets in general. I think the S&P could have another 50 to 100 points. The upside is clearly limited because we're at the end of the cycle, but I think there is some more upside.
Understood. And
Longer term, I guess my favorite asset class would be real assets, commercial real estate, farmland, even housing, broadly, commodity markets, emerging markets. I'm thinking longer term, maybe not just for the next year.
so real assets, basically.
At some point, yes.
Wow, that's an interesting thing. And your take on gold?
Well, I think, gold, if it is correct that in the next cycle we'll see a little higher inflation and a little higher interest rates, then gold probably has some upside. I've never been a gold bug, but it's certainly a real asset. And if the dollar continues to weaken as it has the last month or 6 weeks, and I kind of expect it will, there may be some more upside in gold.
Understood. Last two from my side. Oil, where do you see it headed?
There's a huge amount of production in the United States. There's been so much production that actually Russia and Saudi Arabia have kind of cut production in order to keep prices from falling. So it's really hard to see how oil could go up much higher than where it is in the $50 to $70 range. I think that's it, which is positive for India.
Absolutely, it's a big positive for India. And the last one for the day, which is, though you've mentioned it, but I just want to know your take on crypto. Do you see any future in digital currencies?
Well, it certainly could be. The Chinese government is doing trying to do some research in the blockchain technology that makes that work. I just am not familiar enough with the way cryptocurrencies work. Probably it will come about at some point, but I think it's a lot longer in the future than people say today.
Understood. And before we finally bid you goodbye, Rob, what does it take to be a good economist like you?
You need to read a lot, and I think an understanding of history of financial markets. Just go back, back in the 1600s, the tulip bubble in, 1620 or 1630 was when that was. I mean, there have been cycles of bubbles and collapses, and to have an understanding of those, I think is great for investors. That's even something a retail investor, a small investor could do. Get an understanding of bubbles and price collapses.
Any good books you could mention for retail investors?
I could. I wish I had. I could mention a few. Maybe I'll send you a note
Absolutely, and then we can share it with our investors.
That'd be great.
Let me tell you, this is the first time we have overshot time. Basically, we never do that. But because the conversation was so interesting, and there are a number of topics which we can still cover. However, we'll leave it at this note, and perhaps we'll catch you in your second India visit. You have a great and a safe trip.
Thank you very much.
Thank you. Pleasure. Moneyfront के रेगुलर नोटिफिकेशंस के लिए बेल आइकन को सब्सक्राइब करिए या फिर हमारे इस चैनल को सब्सक्राइब करिए। धन्यवाद।